What if I told you that a single three-digit number quietly controls whether you get approved for an apartment, what interest rate you pay on a car loan, and potentially even whether you get hired for certain jobs? That number is your credit score, and most people have only a vague idea of what actually drives it. Here's what's wild. The average American credit score just dropped to 713. That's the first annual decline since 2013. And the people at the top, the ones with 800-plus scores, aren't doing anything magical. They're doing 5 specific things consistently, and today I'm going to break all 5 down with real data so you know exactly where to focus. I'm Mark at Vault Media. Let's get into it. First, let's talk about what a credit score actually is, because most explanations skip this part, and it matters. A credit score is a statistical prediction. It's answering one question: how likely is this person to miss a payment by 90 or more days in the next 24 months? That's the whole thing. The number, which runs from 300 to 850 for FICO, the score used by 90% of top U.S. lenders, is a compressed summary of your credit history, designed to predict default risk at a glance. Lenders use it to decide whether to approve you and at what rate. A 50-point difference can mean thousands of dollars in extra interest on a mortgage. It determines whether you get an apartment. In some states, it affects your insurance premiums. This number follows you everywhere, which is exactly why understanding it is so important. Now, FICO has 5 categories that make up your score, and they each have a specific weight. Let me walk through all 5. Number 1, payment history. This is 35% of your score, the single biggest factor. It's straightforward. Have you paid your bills on time? But here's what most people don't realize about the penalty for getting this wrong. A single 30-day late payment can drop your score anywhere from 60 to 110 points, depending on where you started. And the higher your score, the harder you fall, because the model is penalizing an unexpected deviation from your pattern. Even worse, that late payment stays on your credit report for 7 years. A bankruptcy can stay for 10. The damage does fade over time. A late payment from 3 years ago matters much less than one from 3 months ago, but it doesn't disappear until the clock runs out. The fix is simple, but has to be consistent. Automate every bill you can. Set calendar reminders for anything that can't be automated. Pay on time, every time, without exception. There's no shortcut here. This is 35% of your score, and it rewards consistency above everything else. Number 2, amounts owed, also called credit utilization. This is 30% of your score, and it's the most actionable factor because it can change dramatically in 30 days or less. Utilization measures how much of your available revolving credit, your credit cards and lines of credit, you're currently using. The conventional advice is to stay below 30%. That's a reasonable floor, but it's not the ceiling. Look at what people with top-tier scores actually do. People with exceptional credit, 800 and above, average just 7% utilization. Not 30%, 7%. People in the very good range, 740 to 799, average 15%. Once you get into the good range, 670 to 739, the average jumps to 39%. And in the fair and poor ranges, it's 61% and 79%.
The lower your utilization, the higher your score. But here's the tactical move most people miss. Your balance is typically reported to the credit bureaus on your statement closing date, not your due date. So if you pay your balance down before the statement closes, you'll report a lower utilization even if you pay in full every month anyway. This is called paying before the reporting date, and for someone trying to optimize their score in a short window, it can make a real difference. Number 3, length of credit history. This is 15% of your score, and it's the patient factor. It looks at the age of your oldest account, your newest account, and the average age of all your accounts. Older is better across the board. The most common mistake people make here is closing old credit cards they don't use anymore. And I get it. You've got a card you haven't touched in 2 years and it feels like clutter. But closing it hurts you in 2 ways simultaneously. First, you eventually lose its contribution to your average account age. Second, you lose the available credit limit it was contributing to your utilization ratio. That's a double hit for no real benefit. Unless there's a specific reason to close it, an annual fee you can't justify, or a card that tempts you to overspend, keep old accounts open. Put a small recurring charge on it, something like a streaming subscription, and set it to auto pay. That keeps the account active without any temptation. Number 4, credit mix. This is 10% of your score. It measures whether you have a variety of credit types, revolving credit like cards, and installment loans like auto loans, student loans, or a mortgage. The idea is that someone who can manage multiple types of debt responsibly is a lower risk borrower. Here's my advice on this one. Don't let it drive decisions. Never take on debt you don't need just to improve your credit mix. The marginal score benefit doesn't justify the cost or risk. This factor will take care of itself naturally as your financial life evolves. Number 5, new credit. Also 10% of your score. Every time you apply for new credit, the lender runs a hard inquiry on your report. A single hard inquiry typically drops your score by 5 points or less and fades after 12 months. The real problem is applying for multiple accounts at once. That signals financial stress to the model. One important exception: rate shopping for a mortgage or auto loan. FICO knows that consumers legitimately need to compare rates, so multiple hard inquiries for the same loan type within a 45-day window are counted as just one inquiry. You won't be punished for shopping around for the best mortgage rate if you do it within that window. Now let's talk about where most Americans actually stand and what that means for you. According to Experian's 2025 data, 70% of Americans have a credit score of 670 or higher, which is solidly in the good range. But here's what's interesting. The share of people with exceptional scores, 800 and above, just hit an all-time high of 22.8%. Meanwhile, the share of people in the poor range grew to 14.7%, up from 13.2% the year before. What you're seeing is a bifurcation. The people who understand how credit works are pulling further ahead. The people who don't are falling behind. And the gap between a 600 and an 800 score in real dollar terms over a lifetime of loans, mortgages, and credit can easily reach 6 figures.
The score also varies significantly by generation. Baby boomers average 747, Gen X is at 709, millennials are at 689, Gen Z is at 678. The pattern isn't surprising. Older generations have more years of credit history built up. But it means if you're in your 20s or 30s, you have significant room to move, and the habits you build now compound over decades. So, here's your actual action plan. I'm going to give you 5 moves in priority order based on the factor weights. Move 1. Fix any active delinquencies or missed payments immediately. If you have accounts in collections or anything currently late, address those first. Pay them current. Call creditors and ask for a goodwill deletion on older late payments. It doesn't always work, but it's free to ask, and sometimes it does. Move 2. Pay down your revolving balances aggressively. This is the highest leverage move for most people. Target getting every individual card below 30% first, then push towards single-digit utilization overall. If you can only make one lump payment, prioritize the card that's closest to its limit. Move 3. Do not close old accounts, especially ones with long histories. If you absolutely have to close something, close the newest one. Move 4. Check your credit reports for errors. You're entitled to free reports from all 3 bureaus, Equifax, Experian, and TransUnion at annualcreditreport.com. Errors affect an estimated 25% of consumers. Wrong account statuses, payments incorrectly marked late, accounts that aren't yours, all of these can be disputed directly with the bureaus, and a successful dispute can remove the error within 30 days. Move 5. Be strategic about new applications. Don't apply for multiple new accounts in a short window. If you're rebuilding from a low score, a secured credit card, where you deposit cash as collateral to set your limit, is one of the fastest ways to establish positive payment history. The people with 800-plus credit scores aren't doing anything complicated. They're paying on time, keeping balances low, and keeping old accounts open. The algorithm rewards patience and predictability. Start the right habits now, stay consistent, and the score follows. If this was helpful, subscribe. We publish financial breakdowns like this every week. And check out the full written guide on our website at marketvaultmedia.com. See you in the next one.